My name is Dayo Ademola. I'm the Nigeria and West Africa MD for Branch International. Branch is a full service digital bank. So we offer loans, investments, debit cards, and all of that. And I'm here basically to talk a little bit about fintech and social impact, and I'll make it quite quick. So, how I've structured this is just to ask ourselves three main questions around this topic, and basically end up with what it is that I think we should be doing as an industry to have more social impact as fintechs. So, question number one: what's the current state of play? Um, Not news to anyone, but globally, fintechs have been able to command the largest share of venture capital investments in startups and in going concerns. And we're largely able to do this because fintech, I think, is one industry that can strike the double good of doing well and doing good, which means you can offer your investors um, you can also offer your investors great returns on their investments, but you can also have a positive impact on the societies that you're operating in because fintech, by its nature, gives you the potential to operate at scale. So just a quick data point. In 2021, Africa and Africa-focused fintechs commanded about 62% of venture funds that were invested, right? And that came up to about $3.2 billion. Still small, is a drop in the bucket of the total amount that was invested globally, but in the scale of what's happening on the continent right now, that's 62% out of all industries, right? So you're thinking head tech, health tech, and everything else that is out there. Fintech took in 62% of this. And a good proportion of that is development and impact funds. Because again, referring to my first point, fintech is one industry that gives the opportunity of great returns as well as having a positive impact on the societies in which we operate. And the way firms design, manufacture, distribute, and sell products and sell their products also impact not just the bottom line, but society as a whole. So my next question is, have fintechs had a significant impact on Nigeria? I think the resounding answer to that is yes. A good data point between 2016 and 2020, looking at the Athena Access to Finance survey, there was a 13% of increase in Nigerians using just payments. And this was almost 100% driven by DFS and fintech, meaning that payment solutions are getting closer to the Nigerian user simply because they're able to use their phones, be they smartphones or non-smartphones, because there are all kinds of services that fintechs and other digital financial services have made available to people. We also saw an increase of the banked population from 38% to 45%, which was a jump of 36.5 million people to almost 48 million people within that time frame. And again, that again is largely attributable to DFS, digital financial services, and fintech. So are we having an impact? Yes, absolutely. Speaking about firms specifically like Branch, firms like us have an impact not just in financial sector widening, but particularly in financial sector deepening. Because while you have almost half of the adult population in Nigeria is banked, a good portion of them have one single product, which is the savings account. Some of them also have a debit card, for example, but a very, very tiny majority of those people have access to credit, which is the most underutilized financial service in Nigeria. So what institutions and firms like Branch are able to do is that if you're already banked, i.e. you have a BVN, you have a savings account or whatever it is, we're able to extend credit to a large group of users that traditional banking in Nigeria is not able to do. I have a data point there that says we've accessed about 4.5 million Nigerians. I was just corrected an hour ago that it's actually 5.2 million since being in Nigeria coming into Nigeria in 2017. So I think again back to my original question, have we had a significant impact in Nigeria? The resounding answer is yes. All right. So, given those two things, here's the larger question: what more could we be doing, and should we be doing? The first thing I think is doing a better job of setting and measuring specific impact goals. So, a lot of times with fintechs, you'll see big impact goals in our mission statements, in our objectives, but a lot of the time that doesn't actually trickle down to goals that we are tracking and tracking key results against. They're just big statements that we make, and then we face the business of doing business rather than also making an impact. And one way to change that is to align impact goals with revenue goals. So, in whatever model that you have built as a fintech, that is a revenue model, that is a profit model, you can actually layer impact goals on top of that. So, if your target is to reach X amount of users, you can layer on top of that a certain percentage of those users should come from a certain underserved section of the country, for example. That's just a single example. So there are many ways in which you can layer impact on top of doing well as an organization. I'm not a big believer in sort of 100% charity work because I personally think that is unsustainable. But if you're able to layer impact on top of good business, that is where you have the largest successes. And again, where there's room, experiment, right? So us as operators spend a lot of time, we're very profit driven. We have investors who have put their cash and their faith in us, and we have to spend a lot of time getting returns for them. But you get to a certain position where there's room in your bottom line for you to experiment a little bit. So dedicate some of your brain trust and some of your profit margin to experimenting. What else can we be doing to reach more people and to have a deeper impact with people? And truly, at the end of the day, you'll see that this largely has a positive impact because if you're taking time to experiment, then you're going to find nuggets in there that actually add to your bottom line. And another big thing, celebrate successes, right? So we have, again, like I said in the beginning, we set these huge impact goals that we write in our objectives without, building all the steps that lead us to achieving those goals. Now, if we celebrate the successes, we build the steps that are all the way that lead us to those big goals. We should also take out the time to celebrate the successes on that journey to getting there. And even when it comes to managing a team, managing your investors, managing your board, being able to celebrate those smaller successes keeps the organization on the path towards achieving the big ones. And again, be flexible. So the last 2 points, I think, feed off of each other. Be flexible and be ambitious, right? If we're honest with ourselves, if we know that the goals that we set for ourselves in January do not necessarily make it all the way through the year to December. And this is because things change. The economy changes. The operating environment changes. The internal operating environment changes. You have new goals. You have new people. You have new focuses. And as well as, being dynamic and flexible in the running of our businesses, we should also be dynamic and flexible in the impact goals that we set for ourselves. And let's be ambitious. As an industry, I think it's important for us to be super ambitious, to set big goals for ourselves, because setting big goals is the only way you achieve them. So think big rather than think small. And that's it. I have a minute left. Thank you very much.